market, you'd have to say. So no movement at all for the headline indices. But yes, metals are back in action today. It could just be a trading pop, but nevertheless, names like Hindalco, Vedanta and Tata Steel are all up about 3 to 10 odd %. Nilesh Shah, Managing Director of Kotak Mahindra, joins us now to talk about the markets and of course all the triggers that are lined up. Nilesh, hi, good afternoon and thanks for joining us. Well, we are heading into the earnings season now, and before the earnings season, a lot of the IT stocks are under pressure. Yesterday it was Infosys, today it's HCL Tech, which is down 5%. What are the expectations as we head into the earnings for this pocket?
So clearly it's driven by the warnings given by some of the major IT companies, where they have talked about either one of the client not doing well or one of the segment not doing well. And now people are extrapolating warning from one company to another company, saying that maybe there is a risk over here also, even though they haven't warned. So my feeling is that in the IT sector, post-September quarterly results, we are going to differentiate men's with the boys. There are companies which have failed to deliver over the last 2-3 quarters. They will get derated. And there are companies which are actually delivering better. The body language, the confidence, the guidance seems to be strong. So those guys have a potential of re-rating. We will see a churn from this set of companies to that set of companies quite aggressively post results.
Okay. I know you don't want to talk individual stocks, but just to follow up to that, HCL Tech has given that revenue warning and the stock has corrected quite a bit since then. But there are still a lot of long-term investors who are very bullish on most of these companies like HCL Tech. Do you keep the faith in a situation like this, or do you sort of churn your portfolio?
So whenever a blue chip company corrects, it's generally a great opportunity to invest, even though it's like catching a falling knife. Now, if I look at the NASSCOM projection, they're talking about $250 billion IT industry over a long period of time from the current levels. So clearly the growth potential no one is disputing. The second thing is related to whether there will be automation of codes, and hence the manpower requirement will come down, and will the Indian companies still have opportunity over there. So my feeling is that in the automation space itself, Indian companies will have an opportunity. And the third is the this whole venture capital industry which is getting developed. Now here the listed Indian companies haven't really invested, but now all of them are talking about creating a fund within their company and putting those money. Who knows, from those investments one day we'll probably see next Google or next some other company. So overall in this sector per se, we still think there is opportunity, we still think there is growth, and the valuation post corrections have become reasonably cheap vis-a-vis rest of the market. So overall we still think it's time to be long IT sector, long or overweight IT sector.
Nilesh, hi, good afternoon. Of course, you have been a big bull on the market, and I know you have been a bit critical of the fact that we tend to look at too many near-term market moves, 10%, 12% corrections, and not look at the larger picture. But having looked at what's happened over the last 6 or 7 months, do you get a sense that something has changed in equity markets, or do you still believe that we are still in middle of a big bull market, which is going to make a mockery out of the current index levels and maybe reward investors handsomely over the next 4 or 5 years?
So I have become far more confident about future of market than I was 6 months ago. 6 months ago there was little iota of doubt in terms of whether we have run little bit ahead of fundamentals. But now with this correction, partially time correction, partially price correction, the valuations have become reasonable. My confidence essentially stems apart from fundamentals on technical factors. One, globally today, if global investor wants to allocate money, most of the emerging markets are clear no to him. Russia because of political reasons, Brazil because of their policies, Indonesia because of reforms not being followed through, China because growth is slowing down. India today is standing apart, and it will get differentiated. We have seen in the month of October long-only funds outstripping the selling by ETFs and sovereign funds. So that's one positive. Over next 4-5 years, I do foresee more flows coming in from global investors in India compared to rest of the emerging markets. Number two, if the domestic investors flow we see, then that's increasing rapidly. Today there are more than 80 lakh people who are doing SIP. Now I just hope and pray that they continue.
Yeah.
But they are going to give 35,000 crore annually to equity mutual funds for investment in market.
And do you think that is going to continue, Nilesh, despite the kind of volatility we have seen? 4 or 5 months back, that was the big question. So far, through the correction, we have seen continuous inflows from DIIs. But if this kind of time correction continues, is there a risk of that flow maybe, receding a bit?
So today, do I see little bit concerns in the minds of investors? The answer is yes. When debt fund starts delivering better return than equity funds over a 1 year period, these concerns are valid. But I'm not yet seeing any impact on their investment decisions. The SIPs are continuing, the lump sum flows are coming in. Most people are trying to time the market, but they are reasonably bullish about the market. The best part which we are now seeing when we host an investor conference, where someone says that, look, I have done SIP for last 1 year and markets haven't given any return. Before we can reply, someone else stands up and says that, look, I have been doing 10-year SIP. 8 out of those 10 years I didn't see any return. But 2 out of those 10, they have covered for all 10.
Okay,
so the word of mouth is now spreading.
But what do you think could be the next big positive trigger for the market, Nilesh, which can take the markets back to the all-time highs?
So one big positive trigger which will come is the resumption of FII flows. We haven't yet seen big supply emerging from the supply point of view. So limited demand which will come from the FII and the domestic put together can tilt the markets to the higher level. More importantly, on a fundamental basis, what we are going to see is the festival season. Last Diwali was not really that good from a consumption point of view. And this year, while there are signs of rural distress, hopefully on a year-on-year basis, this consumption cycle should pick up. This festival should be better. And that support to earnings, that support to corporate recovery should come through. If you see December 14, March 15 and June 15, all the results were below expectation. December 15, March 16 and June 16 on a YOY basis will optically start looking better because the base is lower. So this consumption recovery along with YOY optically looking better could sustain the market for some time, by which the actual recovery will start taking place.
Okay. Nilesh, the other problem for this market has been that for last 6 months or so, there's been no leadership. We had for some part pharma as leader, IT as leader, and then banks really took over. But after that, I think from January onwards, banks have actually destroyed value. What do you think is going wrong in this space? Why are we not seeing value buying in names like, say, ICICI, Axis Bank, a couple of other names? Why do you think these stocks are languishing at the levels that they are?
So if we divide on a category basis private sector banks versus PSU banks, I mean clearly in the PSU banking sector today the worry is related to NPAs. The restructured assets plus declared NPA is a reasonably large percentage of outstanding advances, and the non-declared NPAs are probably even higher. We are now seeing fringe disclosures coming through in some of the banks where the NPA levels have exceeded 10% and RBI is taking corrective action. So clearly the PSU banks are underperforming the market primarily because of worries on the NPAs, which is not declared. The second question probably which is still there in the mind of investors is that what are you trying to do to recover the NPAs? Now that's where we are seeing positive signals from the RBI. They have come out with guidelines which allow lenders to take over the control. There are certain cases where lenders have actually taken the control. Now if this momentum can pick up in terms of recovery of NPA, suddenly this sector looks attractive. On the private sector banks, if we see the correction is more or less in line with the market, it's not significantly higher. 1 or 2 cases probably the corrections are higher because there might be more concentrated selling. But overall the leadership has moved from large cap to mid cap.
No, but in the past, Nilesh, whenever we have seen such corrections in private banks, they have been lapped up. This time there's been a resistance to even buy blue chips, so even after the kind of correction that we have seen, even in the private sector banking space.
So partially it can be explained that people were already overweight that sector.
Okay.
Now, on a technical basis, when people are overweight and there is a price correction, you will see some amount of time before which the buying will emerge. But the point is that, the leadership has moved from large cap to mid caps. Mid caps are up 18% on an index basis vis-a-vis virtually flat index on Sensex.
One theme that has worked very well for investors this year is sticking with a lot of the market leaders, whether it's Maruti, Asian Paints, Sun Pharma, HDFC, Bosch. All of these stocks have given you great returns this year. As an investor, should you continue to play this theme?
I mean, it's a very difficult question to answer because within, companies and sectors, leadership changes.
Because,
so
at the start
in
of
IT
the
sector,
year,
we have seen the returns changing from leader to follower
yes,
and vice versa. So I think it's still a bottom-up stock picking. Certainly there are segments where, conflicts of events are coming through. Say for someone like automobile industry, one, they are rate sensitive and rates are being cut. The cost of borrowing for financing automobiles will come down dramatically, which will boost demand. Second, the consumption cycle is now picking up with wage revision for government employees, public sector enterprise employees. Now, bulk of that money will go towards automobile purchase. And third, automobile sector is benefiting from lower raw material prices. So you are getting economies of scale, you have lower raw material prices, and you are getting demand pickup. Net, they are making huge profits. So clearly then the leader in that pack who has a more than 50% market share is going to dominate the performance. Today, it's a matter of proud for India that Maruti's market cap is bigger than Suzuki's market cap. What more you can demonstrate to foreign investors? You have a choice of investing in Maruti, which is a son of Suzuki, and yet it delivers better market cap. Forget the performance, the overall market cap than Suzuki per se.
So Nilesh, for how long do you think we are going to be in this, bottom-up stock picking market? At the end of the day, stock market is all about individual stock picking, so that should be welcome. But, do you see this kind of scenario continuing for long, where the 9,000 level remains a bit of a peak for the index, but at the same time, a lot of stocks do remarkably well? Do you think that's going to continue for next 6 months or 1 year or maybe even longer? Or do you think the Nifty will at some point break out? Over the next 6 months.
For next 6 months, probably what you say is going to play out. It's going to be bottom-up stock picking market because most of these sectors have been priced for perfection. So there is certainty of earnings in technology, pharma, automobile, FMCG, when they are priced for it. There is concern about metals, power, utility, infrastructure, that's priced for it. So it's becoming very difficult to, get up a sector leadership unless until fundamentals change. So today metal stocks are in absolute value. But, things have to change globally before metal stocks can give sustained return. They will definitely give trading return, but to create sustainable return, things have to change. So for next 6 months, we are probably going to see this kind of scenario where bottom-up stock picking will play a bigger role. But hopefully once we move towards discounting FY 2017, where we will see benefit of interest rate cuts coming into play, and 1% drop in interest rate is 7% growth in earnings. We will also see benefits of government spending coming into economy. That should result into better utilization and better margin for some of the sectors in road, railway, power, utility infrastructure. We'll also see benefit of exports picking up. Whole of FY15, the currency was stronger vis-a-vis majority of the trading partners except dollar. FY16 will be different and FY17 will be even different. So this combination of interest rate cuts, government spending and exports should give boost to the FY17 earnings, and which whenever market is ready to discount will allow Nifty to cross its all-time high.
All right.
Okay, one last question, Nilesh. Since you spoke about interest rates, how much of a game changer was this 50 basis point rate cut and the policy? Do you think that would mean that we will outperform now the rest of the emerging markets, or will we still be prisoners to what's happening to emerging markets, at least in the near term?
So more than the interest rate, what RBI governor came out in terms of roadmap for FII participation in debt market all the way up to March 2018, and the dovish commentary which he gave in terms of real inflation and real interest rates and inflation, I think that combination of three, more than expected rate cut, more than dovish commentary, and roadmap for FII participation, that has probably acted as a catalyst for the debt market, and that has also acted as a catalyst for hopefully investment revival in corporate India.
Okay, well, on that optimistic note, I think the markets took a cue from that and they have moved a bit higher. So now the Sensex is back above that 27,000 mark. Nilesh Shah, thanks so much for joining us. And we encourage you to keep joining us in the studio. It's fun to have you here in the studio rather than have you on an OB van. Thanks so much for being with us.